Imagine waking up one morning, your life savings gone, your home no longer yours. Not because of a natural disaster, but because of decisions made in distant boardrooms. This isn't a story of natural calamity, but one of human ambition, unchecked risk, and a system pushed to its breaking point. In the autumn of 2008, an economic storm of unprecedented fury swept across the United States, leaving a trail of devastation that touched nearly every American home. Millions found their dreams crumbled, their futures uncertain, and their faith in the financial system profoundly shaken. How could such a catastrophe unfold in the world's most powerful economy? This is the story of how it happened, and the lasting echoes it still sends through our lives today. On streets once bustling with life, for sale signs became a grim universal symbol. These weren't just houses. They were homes, hopes, and the very foundation of the American dream, now marked for repossession. A crisis unlike any in recent memory had gripped the nation. It wasn't an earthquake, a hurricane, or a war. It was an invisible enemy, born of complex financial maneuvers and human fallibility. Yet its impact was as visceral and devastating as any physical disaster. Families found themselves caught in an unforgiving current, swept away by forces they barely understood. From the sun-drenched suburbs of Florida and California to the burgeoning communities of Nevada, these signs multiplied, each one representing a family's loss, a future derailed. The scale of the pain was immense, and the question on everyone's mind was a simple yet profound one. Why? To understand the unraveling, we must first look back to the years leading up to 2008, when the U.S. housing market was experiencing a boom like no other. It was a time of seemingly endless prosperity, fueled by readily available credit and an almost intoxicating belief that home values would always go up. Buying a home, once a significant life decision, started to feel more like a guaranteed path to wealth. Banks and lenders were eager to hand out money, sometimes to anyone who asked, often with little regard for whether they could actually pay it back. This insatiable appetite for profit, particularly on Wall Street, led to some truly inventive and ultimately dangerous financial engineering. Here's how it worked. Thousands of individual home loans, often grouped together, were sliced and diced, then repackaged into complex investment products. These products, known as mortgage-backed securities, or MBS, were then sold to investors all over the globe. Think of it like this. Imagine taking thousands of different types of fruit, some ripe, some a little bruised, mashing them all together, and then selling it as a delicious, guaranteed smoothie. As long as people kept buying homes and paying their mortgages, these investments looked fantastic. But the problem was, many of those fruits were far from ripe, and the smoothie was built on fundamentally shaky ground. This elaborate structure created an illusion of stability, a house of cards that appeared solid, but was ready to topple at the slightest tremor. Lurking beneath this shiny facade of prosperity was a dark secret, the rise of subprime mortgages. These were loans offered to individuals with less than perfect credit histories, often those who wouldn't qualify for traditional loans. On the surface, it seemed like a noble idea, extending homeownership to more people. But the reality was far more predatory. Many of these subprime loans came with deceptive terms like teaser rates, low initial interest rates that would suddenly skyrocket after a couple of years, making payments impossible for many borrowers. Hidden fees and complex clauses often trapped unsuspecting homeowners. Why did lenders do this? The answer, in large part, was greed. Everyone from the loan originators to the Wall Street banks that packaged these loans was making massive profits. There was a widespread belief, almost a delusion, that housing prices would continue to climb indefinitely. This meant that even if a borrower couldn't make their payments, the house could simply be sold for a higher price, covering any losses. It created an illusion of wealth for both the borrowers, who suddenly found themselves in homes they couldn't truly afford, and the lenders, who were raking in fees. But this entire system was fundamentally unsustainable. It was like filling a balloon with too much air. Eventually, it had to pop. And when it did, the consequences would be catastrophic for those who had been told they could finally achieve the American dream. The first tremors began earlier, with foreclosures rising and some investment firms collapsing. But September 2008 marked the true earthquake. The financial system, already under immense strain, faced its ultimate test. On September 15, 2008, a name that had stood as a pillar of American finance for 158 years simply vanished: Lehman Brothers. This venerable investment bank, the fourth largest in the U.S., declared bankruptcy. It was an event that sent shockwaves not just through Wall Street, but across the entire global economy. Suddenly, the elaborate web of financial trust that connected banks, businesses, and nations snapped. No one knew who held what risky assets, or which institutions might be next to fall. Markets around the world plunged into a freefall. Confidence, the lifeblood of any financial system, evaporated overnight. Lending between banks, the very mechanism by which commerce flows, froze solid. Businesses couldn't get loans to operate. Individuals couldn't secure credit. The gears of the economy ground to a halt. It wasn't just a crisis. It was a systemic threat, a moment where the entire global financial system teetered on the brink of complete meltdown, threatening to drag everyone, everywhere, into an abyss. The fear was palpable, a chilling realization that the carefully constructed edifice of modern finance was dangerously fragile. Faced with an economy on the edge of a precipice, the U.S. government, under President George W. Bush, was forced to make a series of agonizing decisions. The choice was stark: let the market correct itself, risking a complete economic collapse on par with the Great Depression, or intervene with massive taxpayer money. The decision was made to intervene. Congress authorized the Troubled Asset Relief Program, or TARP, a colossal financial industry bailout that would inject billions of taxpayer dollars into struggling banks and institutions. This move, while deemed necessary by policymakers to prevent total catastrophe, sparked immediate and widespread outrage across the nation. How could the same institutions whose reckless behavior led to the crisis now be rewarded with public funds? It ignited a ferocious national debate about accountability, moral hazard, and the very role of government in a free market economy. Protests erupted. Politicians wrestled with the unpopularity of the measures, but ultimately, the argument for protecting the broader economy won out. The government bought stakes in banks, effectively nationalizing parts of the financial system for a time, and provided emergency loans to others. While controversial, these actions arguably prevented a total collapse. The immediate financial panic subsided, and the patient was stabilized. But the cost was significant, not just in dollars, but in a profound erosion of public trust in both financial institutions and government. The rescue, while effective in preventing the worst-case scenario, left a bitter taste in the mouth of many Americans who felt they were bailing out the very people who had caused their hardship. The financial crisis of 2008 was not an abstract economic event. It was a deeply personal tragedy for millions of Americans. The economic fallout was immediate and devastating. Businesses, unable to secure credit or facing plummeting demand, laid off workers in droves. Millions lost their jobs, their livelihoods stripped away. For families across the country, eviction notices became a chilling reality. The very homes that represented security and belonging were snatched away, often leaving families with nowhere to go. Retirement savings, painstakingly accumulated over decades, vanished in the market downturn, shattering the golden years many had dreamed of. The American dream, a bedrock promise of hard work leading to prosperity and security, suddenly felt like a distant memory for many. For a generation, the crisis left an indelible mark, shaping their views on finance, risk, and the fragility of economic stability. The ripple effects touched every sector of society. Education budgets were slashed, public services strained, and charitable organizations overwhelmed. The emotional toll was immense, marked by stress, anxiety, and a profound sense of injustice. Unemployment, a key indicator of the crisis's human cost, steadily climbed, eventually peaking at a staggering 10% in 2009. This figure doesn't just represent statistics, it represents individual stories of struggle, hardship, and the painful reconstruction of lives that had been unexpectedly upended. The trust in financial institutions, once a given, was fundamentally eroded, replaced by a deep skepticism that continues to this day. The 2008 financial crisis serves as a stark, enduring reminder of several critical lessons. It underscored the profound interconnectedness of the global economy, demonstrating how reckless decisions made in one corner of the world can send seismic shocks across continents. It also laid bare the immense dangers of unchecked greed and insufficient regulation, proving that without proper oversight, even the most sophisticated financial systems can become instruments of their own undoing. Today, more than a decade later, the U.S. economy has recovered, and many of the institutions that faced collapse have been rebuilt. Yet, the scars of this crisis remain, visible in heightened regulatory scrutiny, though debates about its effectiveness continue. More importantly, they are visible in the collective memory of a generation that lived through it. A generation that now approaches economic stability with a cautious eye. The crisis forced a confrontation with uncomfortable truths about economic inequality, about the true cost of ambition when pursued without ethics, and about the fundamental balance between individual liberty and systemic responsibility. The questions it raised about who benefits, who bears the burden, and who is ultimately accountable continue to resonate. The answers we seek to these questions will shape not only our financial systems, but also the very fabric of our society for decades to come, ensuring that the lessons of 2008 are never forgotten. If you want to delve deeper into the ripple effects of this crisis, watch our next video right here.